subscribe now and press the bell icon. Never miss an update.
So adoption assistance program, it's very common to see, kids being adopted in US. That's like, it's not a very uncommon thing there. So that's why IRS has put up this rule that if you're adopting, and anyways they want to encourage the adoption, because the families system is not that strong there. So a lot of kids are, orphans and all. So there is some exclusion that if the person is adopting a kid, then they get some kind of exclusion amount from their taxable income. And any of the adoption expenses also are deductible, or they can be excluded from the taxable income. So they are giving what is the maximum exclusion amount for 2019, but this must have changed for 2022. Maybe it has become 15, 16,000, 17,000. We don't know right now, and it keeps changing. So more than that, what we should be interested in knowing it, there is some kind of exclusion if the family, or if the person, not even family, like any single person can also adopt and all. So anybody who is adopting, then they get the benefit. If the child who is being adopted is a US citizen or resident, then the exclusion is taken in the year the payments were made. There could be, so what are the expenses for adoption? There could be some legal expenses, notary, or some reasonable travel and all to go and, visit the places where to adopt the kid from and all those things. So all the reasonable expenses, they're all deductible. And for if it's a US citizen or resident who is being adopted, the child, then you just take the exclusion in the year the payment is made. But that's not the case with foreign child. So if a foreign child is being adopted, then the adoption, all the legal formalities have to be over. They have to be final. The last thing, whatever we get from court and all clearance should be done. And this process may take up to like 1 or 2 years and all, because there's a background check that they do and all other different kind of things. And after that, the adoption is approved by the court. So that may take time. So what they're saying, if you're adopting a foreign child, which is also very common, people get like, if they go back to their country, they may want to adopt, or they may have some relatives or whatever. So then they don't get this benefit. They have to wait. They have to provide all the papers that, okay, this is all final. And then only then they can get the benefit of deducting the expenses. So what are the qualified expenses? Any reasonable and necessary adoption expenses. If you think something is really reasonable and necessary, making visits to the orphanage, or going to the attorney, or paying the attorney fees, or court costs, or kind of agreements and all those expenses are very reasonable, and they're also necessary to complete that process. But there are certain other expenses. What they have given is they are not eligible. I mean, surrogate parenting arrangement, that's also quite common. But then surrogate, people charge huge amount or whatever, or they can be anything. It's not something that IRS will approve. That's your own personal expenses. You don't get any benefit for that. Anything that you are, obviously, if any expense which is being incurred in violation of any state, federal, or local law, that's not allowed. And there might be local laws related to adoption that you cannot do this, cannot do that, and all. Expenses incurred in connection with the adoption of a child of the taxpayer spouse. Obviously, this is like if the person has married another person, and from the first marriage or without marriage or whatever, if the spouse has a child, you don't say that I'm adopting my spouse child, so I need a break from the expenses. No, that's understood. If they're marrying, that means it becomes a stepchild. So there's no adoption taking place there. Okay, that's not allowed. You cannot call that I'm adopting my stepchild, because that kid already has become a child by way of marriage. Okay, that's it. I think that's it. There's not much over there. Any reimbursement for living expenses? Yeah, this is also very common in US because a lot of these natural calamities keep hitting. Sometimes there's a huge flood or wildfire, like the forest fire, and all those are very common. Every year, millions of people have to move here and there because California forests, they catch fire. And the fire is so huge that it takes like months to take that in control. So a lot of people, those who are living in mountains and all, they'll have to get relocated, or their houses may get damaged and all, or there would be huge hurricanes and all, which is also, we have seen that keeps happening every other day. So, or the earthquakes and all. I mean, the big one happened a couple days back. Yeah, we all know about it. I'm pretty sure you must have seen the news. And also, something like that happens when the residence is damaged or they have to move to some other place. And then, whatever the insurance payment, if there's anything which is received, it is not considered to be an income. Even people with undamaged residence, doesn't it's not required that your house has to be damaged by flood or by storms or by anything else. Sometimes it doesn't, nothing happens to the house, but still there is a warning which is given by the government that you all have to evacuate and move to some other place. So the family, when they're moving out, they'll probably find another place to live and to have eating expenses, all other things over there. So those expenses are deductible. Okay, because that is something, I mean, they cannot avoid it. Okay, then reimburse employee expenses. Any expenses which are reimbursed to employees, obviously they're not part of the income because the name itself suggests the employee has incurred certain expenses and they're being reimbursed. But if the reimbursement is higher than the expenses incurred, the the difference amount has to be put up as an income. Either employee gives it back to the employer if they don't do it, or whatever reason, if it cannot be done, then that should be getting added to their taxable income. Employee housing at educational institution, that's also, like, I mean, a lot of these professors and all, they get housing right in the university or in the college campus and all. So what they're saying is, fine, you can you don't have to. And usually they're supposed to pay some kind of nominal rent also. If it's completely free, then it becomes as part of their compensation. If they're paying something, then they need to make sure that whatever the rent is paid is actually equal to the fair market value. But usually that is the rule. It has to be equal to the fair market value. But here what they're saying is, it needs to be more than 5% of the fair market value. I have no reason why they're saying that. Like, I mean, why would they put it this way? But usually the rents are supposed to be very, very low in those campus, and also the maybe just outside the campus it could be high, very high, and there you'll probably get it for like 20-30% cost. And also um, there's a good room for tax saving over there. So what they're saying is, it has to be like fair market value or 5% more of fair market value. Sorry. Next one is all fringe benefits. We'll quickly go over them. There's nothing like very complicated over here. Fringe benefits are the benefits given to employees, right, as part of their employment with the company. It could be like free parking, or it could be free telephone or internet. I mean, obviously internet has to be there, but some telephone, now it's like the telephone doesn't cost anything, but earlier the telephone bills used to be very high. But if you are in the office, probably people use that and all those things. So those are all considered to be fringe benefits. It doesn't need to be considered as an income. But there are certain benefits which need to be considered as an income. Let's go over that. There are certain points here, like some 6-7 points, whatever. We'll go through them one by one. First one is no additional cost service. That means it should not cost anything additional to the employer. So if it's not something that employer is incurring to give a benefit to employee, then it's all part of their business expense. It's not like they're putting something extra to give some benefit. So they call it no additional cost benefit. The employer must not incur any substantial additional cost. Example is free telephone service. The telephone has to be there. So if employees are using that, it's not a no additional cost thing. Then all the benefits need to be available on non-discriminatory basis. Again, this is very important. Whatever benefits are given, it has to be same for all. If there is a discrimination, if the people on different position get different benefits, then the people on the higher position, obviously they are going to get higher benefits, right? Then their benefits should become taxable to them. If it's same thing for everybody, then they say that's part of running the business. But providing something more to others and something less to the other people, then it's a discriminatory. It's called it's called discrimination. So then IRS doesn't give that exclusion. Employee discount, again, this is very common, right? If like employees working in a store, they get discount, or if they're working with Microsoft or say Apple, like if they're buying their products, they get some 10, 15, 20% discount. So again, this thing is very, very common. Does that need to be considered as their income? Maybe yes, maybe no. What we need to see is how much discount they are given. If the discount which is given is like 20%, up to 20%, that's fine. You don't need to, because they're employee and also it's expected, it's part of the regular business practice that they'll get a better price than the outside people. So obviously, like up to 20% is reasonable and all. Again, discounts must be available on non-discriminatory basis. We cannot say that some people will get 10%, others will get 15%. Discrimination is one thing which is never allowed in US. Whatever field we are in, not just tax, anywhere. Working condition, fringe, okay, working condition. So any um, what could this be for? Any working condition, like if there is like vehicle given to the employee, like if they have to be on road all the time, the job is such that they have to move around and all, then those should not be considered as a benefit to them. The FMV, the fair market value of property or services provided to an employee by an employer as a working condition. So because they are using that to, it's not like they're provided. If it's saying that okay, you're just provided on the weekend, on every Sunday you go and take out company's car and go around and have fun, then it's not a working condition fringe benefit. Then it's something extra which is given to the employee. So we have to see what is reasonable there. We have to use your own judgment also. What is ordinary and necessary business expense, depending upon what duty the employees is like taking care of, or an employee is fulfilling. And depending on that, all these like working condition benefits could be deducted as ordinary and business expense. If the employee has to be on continuous travel, then there's some travel allowances given, there's some meals reimbursement and all those things. So that is all allowed. Again, IRS has a limit for that. We cannot say, okay, every day you'll get $500 as per diem when you're traveling. Now, that's not a reasonable number. But if you say, yeah, okay, every day if you have to stay in a hotel, eat outside and all, and you're given like $150, $200, then that's reasonable, because the hotel cost and all other costs would come up to so much amount. Okay, then de minimis fringe, which is like really, really minimal. That's nobody is even going to count on it and all. But then, as far as IRS is considered, they're going to put everything here in the code. Something like as simple as like coffee, donut, any simple holiday gifts and all, or any occasional company parties and all. I mean, those are definitely not considered to be income. But there has to be a limit on that as well. What they're saying, the season tickets to sporting events. People go for the sporting events a lot in US, and it's very common to for the employer to provide these tickets and all. So but only once in a month and all is fine. Every week if they're giving, because each ticket may cost up to 150 $200. So it's not like $10 $20 tickets. So what they're saying is once a month is fine, or membership to a private country club or athletic facility, they're not excluded as de minimis. Because if their employer is saying, okay, we'll get membership to this club and all is $100 per month and all, we're going to pay on your behalf, so that is not you know a benefit that will be excluded. Any eating facility, that is also not considered to be taxable if if there is a minimal charge that employees are paying for that, and if the revenue derived from that facility basically equals the cost. So that means employer is not running that cafeteria for making profits. It's just to cover up the cost and all. So that's called de minimis fringe benefit. Okay. Then again, there might be on-premises athletic facility and all, or on-premises dance facilities. Okay. So, okay, can someone read this? Sakshi? I hope it's not going to echo, huh, if I ask you.
Yes, ma'am. An employer provided meals at its own eating facility and at the direct operating cost of the facility exceed the annual revenue from the facility. Because the cost exceed the revenue, the benefit is taxable to employees.
Yeah, so one thing that they need to make sure is that then they should not be running this as a business, like sorry, as a means of giving more benefit to employee. I mean, it should be enough to cover up their cost. If they are incurring more, in providing that facility, then there's something that, like, some in some form the perks or perquisites are being passed on to the employee. So what the IRS says is that then you make it as taxable. Maybe it's quite possible, right, that some one plate of food may cost like 20 rupees or 30 rupees, just the cost part I'm saying. But you're actually charging only 2 rupee to the client, that okay, come and take it in 2 rupee or 5 rupees and all. So that way they are incurring a loss, like, because the out of pocket expense is only like 20 rupees, but you're charging only 5. So at least charge 20. And that way the entire facility is run only to give that benefit to the employee and not to make any um, losses or profits. Okay. Transportation, again, that's very common, that, like, parking is very expensive in states like New York and all. People pay like up to $500 per month only for parking and all. So what they're saying is, or the train passes or transit passes and all, because people are a lot of times people commute in trains. Okay, so they have given some kind of limit that up to $265 per month. Sorry, yeah, per month is fine. Again, that's 2019. We have to check what is the limit now. But what we need to do is, whenever this kind of situation comes up, go to the IRS website, see what is the limit for that year. If you're crossing that by providing benefits more than that, then it should be taken as a taxable element in their paycheck. Okay, then employer provided educational assistance, that's also common. There are, in order to improve the skills or something related to their job, if the employer is providing some assistance, that okay, fine to do this kind of courses or other things and all. So there is a limit for that. You cannot go ahead and say, okay, I want to do this $50,000, and maybe the employer is also ready to pay, because this is how they're designing their compensation thing and all. But in that case, they're not it's not being taxed, so IRS is going to lose on the revenues. So what IRS is saying, that yeah, education and all, that's fine, it's needed. So there is a limit of $5,250. Okay, then foreign, this is our favorite topic, foreign earned income exclusion. Okay, which form do we need to use for this? So that's, again, this is form 2555. What is the approach that we take? Again, and why is this needed? I mean, the other countries will not have these kind of forms or this even this code and all. This is needed because of the basic rule that we talked in the very first class, that US citizens and resident, US residents or permanent or sorry green card holder, which are called permanent resident aliens and all, they are uh, they are subject to worldwide income, taxes. They have to report worldwide income in their US taxes. Doesn't matter where they live. So that's why the government has to give this benefit that, okay, if you are staying in a foreign country and you have to include this income as part of your worldwide income, because that's what US law says. Doesn't matter if you've taken up citizenship or a green card or if you're US tax resident. Maybe you're just on H1B visa, but you are a US tax resident. So you have to report worldwide income. India doesn't have this thing because India doesn't even want, like, I mean, people, those who are out of India, they're considered non-residents. So they don't care about what you're earning outside the India. They'll just care about the sources of income coming from India. So this is why this special exclusion is included, because people may come and say, like, US government is charging so much of taxes for no reason. It has nothing to do with US, and unnecessary we have to put like all our worldwide income to be taxed in US and all those things. So US government is saying, yeah, fine, we understand this part, but that's how our laws are. But in order to be fair, we'll provide $100,000 exclusion. Whatever you are earning outside of US, you straight away get up to right now the limit is 108,000, 109,000. They're talking about 105, but it has gone up. So straight away you exclude that income from your AGI. Okay, so you will not be taxed on that income. And when we do the tax returns, we always have a choice. We can go with foreign earned income exclusion by filing this form 2555. Or what we can do, we can tell IRS that, okay, we don't want you to exclude this income. Okay, we are ready to pay taxes on this income in US. But we have already paid taxes in India or in any other foreign country. So you provide us a credit for that. And we'll give the proof that we have paid taxes and we need you to provide the credit. So there are two methods of doing it. Either we tell IRS, you just give us a straight away break of approximately $110,000. Exclude it from our income right away. Just cut it out. Or you can include it, but then you give us the credit. But you give us the benefit of those foreign tax credits paid out. We have to understand what is going to be beneficial for the client in the long run. We cannot keep changing this approach that one year we'll go with exclusion, another year we'll go with foreign tax credit method. That's not something IRS will allow. So we need to be very careful in what method we are choosing, because we need to stay with that method for at least 5 years. And with 2555, this is again a very, IRS thinks it's a very, special benefit that they're giving. So what they say that we are giving you this exclusion benefit. If you take this exclusion benefit and next year if you don't want to take it, it's fine. But we will not allow you to take the benefit again for next 5 years. Because in a way they're penalizing. They're saying that, okay, we are already giving you, you have taken that, like you cannot keep switching, but still if you want to switch, then fine, you're not allowed to come back to the exclusion for next 5 years. There's no such condition in foreign tax credit. Like from any time from 1116 approach, we can move to 2555. But once you have taken 2555 approach, you cannot, and if you decide to move away from there, you cannot come back to it for next 5 years. So we have to make this decision very carefully. What is, like, especially in the very first year when they have come out of US, or when they still live in US, but they're having foreign income from outside US. We have to understand, like, for how long this income is going to come, what is the amount of that income. And we should do an analysis that if the same amount is going to come for next 3, 4, 5 years, everything else if remains same, their family and everything else, because the family has to be considered while filing the returns. Married filing jointly, maybe 1 or 2 or 3 dependents and all. So they need to, like, if everything else remains same, then what approach is going to give more benefit? This is in lieu of foreign tax credit, so we cannot take both of them at the same time. But I mean, a very reasonable question may come in your mind, that what if the person is making 200,000 in a foreign country? They get the break of only 100,000. What happens to next 100,000? Tanya, can you tell? They will not get exclusion for more than, okay, whatever this amount is.
Get taxed.
Hmm?
Get taxed.
Explain. Get taxed. Get
Yeah.
taxed mean what? Get taxed or get tax credit?
No, but I think the software doesn't entirely take that tax credit. That's what we saw for one of them last year. So whatever amount of exclusion happens, that comes on 1040 as a negative amount, and whatever is your AGI, that amount, I mean, the normal calculation happens.
Yeah, but I think my question is, if the income is $200,000, you're getting a credit, you're getting exclusion of $100,000. What happens to another 100,000? Do they have to pay full taxes on it? So there's no
We
even
we
more.
do take the tax credit on 1116, but I don't know how exactly it taxes it.
Come on. Okay. The answer is simple. Of course, if you're not able to exclude it completely, you can always go ahead and take foreign tax credit. It's on the same income, we cannot take exclusion as well as credits. So if the income is more than $105,000, on the remaining portion of income, it will come automatically in the software. Maybe Tanya, I don't know, like maybe there was some glitch or something, but it will come in the software. Because it will come in 1116. What we need to do is, we just need to input how much was the total tax paid on $200,000 in a foreign country, and that total tax, $200,000 total tax, will get reduced by the same ratio. So if 100,000 is allowed as exclusion, 100 is remaining, then like 50%, right? 50% going in one category, 50% in another category. And so if you're saying that on an income of $200,000, I paid $60,000 in India, that's a 30%. We just have to put that 60,000 there. The software will automatically reduce it to $30,000 of credit that can be claimed, and out of 30 you may not get full 30, right? You may get only 10 or 15 or 20 as the benefit, but no one is paying some extra taxes and all. It's not like, okay, if you cannot take, we should not think that, okay, exclusion is giving only $100,000 of relief. So what happens if the income is more than 100,000? Maybe I should not go with exclusion. That's not the case. You can always go and get foreign tax credit on the remaining income. So it will come up in 1116. We have to put in full taxes. Even taxes get prorated. There are certain conditions to claim that exclusion, that the person has to be staying in a foreign country. They cannot keep staying in a US, in US, and they say that, okay, I'm, 25, 55. The condition is you have to be physically present in a foreign country for at least 330 days during any period of 12 consecutive months, whichever is, even though that period is ending in the year in which we are filing returns. So maybe let's say the person moved to India in July of 2022. We will be filing returns in April of 2023. So obviously 12 months are not over. But if we can get an extension and we file it by October, and we say that, like, from October till, if we count back, we are fulfilling this condition, that for a period of 12 consecutive months, that person is there. At least 330 full days. Of course, a person can go out and travel and all those things, but he or she has to be physically present. Okay. and there has to be an income tax treaty with that country. He has to show that he's paying taxes in that country. So there is certain, like when you go to that form 2555, it will ask certain questions that is this person, is the taxpayer resident, a tax resident of the other country? Does US has a treaty with it? Or how many days the taxpayer has spent in that country? Okay, or is the taxpayer paying, is the taxpayer's main home in that foreign country? So that is also important. If all those conditions are satisfied, then we can take deductions. We can take exclusion. Sorry, I should use the right word. So it is called exclusion. We can take exclusion. Okay. So foreign, wait a minute, deductions attributed, and it's all, I mean, so this is only on earned income. We are not talking about unearned income. We are not talking about passive income. This is like only when the services have been provided. It could be consulting, it could be employee services or whatever. It has to be earned by putting in your own time and providing your own skills and services. So these, we cannot take dividend, interest, capital gain as part of the exclusion and do this thing. Only earned income has to be there. Okay. Housing allowance, yeah, if you're staying in a foreign country, the IRS also gives some kind of housing allowance, so we can always take that as a deduction as well. So they're giving some limit of 31,000 and all per year. And again, they have two different set of locations. Like IRS has to see if you're taking if you're moving to London, obviously the rentals are very very high there. So they always do this adjustment. So this limit, what they are providing, may not be applicable for India, but it might be applicable for other places. So they have broken it down into high cost location and all. What is high cost and also for those areas, the limit is high. So high foreign housing allowances can also be taken as an thing. And the next portion, that's fine. We can always see this limit and all, but what we need to know is like just in that form 2555 only, below everything, there is something called housing allowance, and we can always put in the number. We can ask the client that how much rent you are paying in those, in a foreign country, and convert it into dollars, put in those numbers and see if we can get any benefit. Okay. So there's certain amounts which is excluded from income. There's certain amounts which are included in income. So the first $16,000, because everybody's supposed to pay some rent. So what IRS is saying that, okay, first $16,000 you have to, even if you're getting a reimbursement back from your employer, you have to include that as an income. But the next portion is again in the list of high cost location and all. If you're paying more than 31,000 and all, then you can exclude it from income. Any questions so far? This is an important section. We need to understand it thoroughly.
Didi, this housing allowance is not clear. It's one thing is that the pay component includes HRA. Another thing is rent paid. So what should be reported there? I mean, how they are saying 16,000 is to be included in balance?
Meaning, I don't understand. Like, can you say it again?
Yeah. So payroll, the salary component includes HRA benefit.
It doesn't matter, no? It doesn't matter. We take the full salary, or you can take it like, okay, I'm earning, the person is earning 10,000 per month, 5,000 per month. We don't have to go with what Form 16A is showing.
No. This housing allowance. So
Mhm.
we are reporting rent paid there.
It may not be there. It may not be. Like, are you talking about in the country where the person is residing, in a foreign country, or in US? This is in, like,
In
where it's
US. In
included
US in 2555 form where we are reporting housing allowance information for exclusion or whatever is yeah.
Yeah.
Okay. So it's like the first 16,944 or whatever number of any foreign housing reimbursement is includable in income. It means reimbursement. Does it mean that HRA component? Because that is reimbursement.
Yeah.
Or whatever rent is paid, full amount can be claimed as deduction. I mean, we need to report both the
I mean,
parts.
we need to, I don't know what will be, I mean, see, HR allowance and all those, whatever the employer is giving and all that's, like, we just have to see what are they getting reimbursed, because this is a common thing. If the person is being sent out of US for a year or two, usually a lot of times their housing is covered by their contract with the company, saying that, okay, you have to stay in some other countries for 12 months, 18 months to do a project, and we'll provide this housing facility. So if the person
Oh,
is
okay.
not paying anything at all, we have to understand like how much is the housing that should be taken as a benefit, or if they are paying but it's getting reimbursed. Maybe the contract will say that, okay, you pay to the landlord up to $2,000 per month, will reimburse you back. Okay. So what IRS is saying that you cannot like take full benefit of fully like the entire housing thing, because as a part, this is part of our basic living expense. As like eating, right? We will need food to eat every day. So we cannot say that, okay, I need a full deduction of on all my grocery bills because my employer has sent me here, so that's why I'm buying it. No, wherever you are staying, even there you'll need food. But food ke liye, the employer is not with. Usually the contracts, the expats contracts will not talk about food and other expenses, but they'll say, okay, we'll get like a car or driver or housing facility, right? Those things are usually given as benefits. So regardless of whether it is included in the foreign country's taxation structure or not, what IRS is saying that if you are getting a reimbursement, which is very common because everybody who is going out of the US will not straight away go and buy the house. So the rental portion has to be there. So what IRS is saying, this is part of your basic living expense. So you if you are getting it all reimbursed, at least some part needs to be incurred by you. So this $16,000, this is what the number that they have come up with. That you need to make sure that this is included in your income. Anything else you're paying above that, then that's something because the employer has asked you to go there and stay in that city or in that area only. That's why probably have to incur more expense.
So, okay, one more confusion. Say, for example, Akshay Agrawal will go for 2555. So, will he get this benefit, or someone who is expert only, that person will get
No,
this benefit?
they're not giving any. Usually these benefits are given to expats only, but IRS has not given any limit or on the amount of stay outside the country. They're not saying that you have to, if you are an expat, you have to be like, staying outside only for 8 months, 12 months, 18 months, whatever. So technically, yes, he can take it. But usually what I have seen is like we have taken it for a lot of clients and all, they really don't get any big benefit out of this.
Okay.
Unless they're paying very huge rent. And rents in India are not that huge. Like, I mean, they're either having their own houses and all. So even if they're paying like 1 lakh rupees a month or 2 lakh rupees a month, it is still like, below I mean, it's not as big number to give them any benefit. But that might not be the case if they're going to London or if they're going to Israel, or if they're going to any other very high cost country where the rents are super high. And that there they may get this benefit. Okay, so we'll have to first, the thing is that we need to ask client, are they really paying rent? If they are paying, how much it is, how much does it come to when you convert it into dollars? And then see that like, does it come to less than $17,000 or not? That is the first thing, right? If they're not even satisfying the first thing, then doesn't like they cannot take any allowance.
Okay.
If they're paying more than 17 or $18,000, say they're living in a very high posh some Mumbai area and somewhere, and they're paying huge rent, there it may give them benefit.
Okay. So my question is, in 2555, say if someone has foreign income of $200,000, if it is $200,000 is his income from India, that 200,000 includes 50,000 HRA. So when on the top we are reporting foreign income, we are going to report 200,000,
No, but then you
or
need to see HRA is what? HRA is just an allowance. It depends upon what he's actually paying as rent.
Mhm. But that's the reimbursement now for rent. They are saying reimbursement part. So we'll show full amount there, or 200 minus 50K, whatever is the reimbursement.
You have to see what is the full amount which is coming up as taxable to him.
Okay.
So that is like when he's getting an allowance.
Hmm.
Okay, that's fine. But then, how much is he really spending on on rent? Again, like same calculation that you do in India. What is
Hmm.
the tax like actual amount that the rent, actual amount of rent that they're paying and all? So you have
Hmm.
to see the what is the actual amount of rent. Like say if he's paying $20,000 of rent and he's getting 50,000 back
Hmm.
from the employer, right?
Hmm.
That means
Hmm.
he's getting $30,000 extra. That $30,000 will be taxable income, which anyways would be here, whether he gets it from
Hmm.
which anyways would be part of the taxable income.
Hmm. Hmm.
Now, only thing is that can he get this $20,000 what he's paying out of the pocket as a deduction here?
Hmm.
So that $50,000 of HRA, which is included in 200,000, now the 200,000 to taxable income hai hi uske.
Hmm. Hmm.
Right, then we can see if 200,000 can be reduced to 150, 170, 180 by seeing actually what rent he has paid out.
Hmm. Hmm.
And that is for 25, 55. So we are not talking about, we are not even talking about what tax he is paying in India
Hmm.
because this is not related to foreign tax credit.
Hmm.
There's nothing to do with that. Okay. Okay. Let's go to the next one. So what is a rebate? Rebate is a lot of times we see that when you're buying certain things, you get some. It's a kind of discount, but it comes in later. That's very common in US. Let's say they say that there is a rebate of $100 on the purchase of this TV. So if you're paying like $1,000 for a TV, after like couple weeks and all, you'll get $100 back from the store or from the manufacturer or whatever. So what they're saying is rebate is not an income; it is a reduction of the purchase price. So if you're buying something for $50,000, say you're buying a car, and the car manufacturer says we have some rebates going on right now. If you buy it Thanksgiving time or some sale time, you'll get $5,000 back. So we will not take that $5,000 as an income. What we'll do is we'll adjust the cost basis of the car and saying it's not costing 50,000. It's actually the basis is now 45,000. Okay, that is not considered as an income. If that would be considered as an income, again, like I mean, people don't get the full benefit. They're like 30% goes away in paying taxes. It's not. It's not like it doesn't serve the purpose. The rebates and all are given. They're like discounts at the time of sales and some festival time, and those rebates will be given that they're the you get it at a better price and all. Okay, we'll quickly finish up this thing also. Community property income. Who remembers what is community property? Does anyone remember? Honey, do you remember? Raksha, you must be remembering. We have like or Tanya, Shweta, you guys remember? No? Okay, so community property is the community property is a law which is very common for certain states in US, and the term is also very common. Community property. They're not talking about the whole community or society or anything. What they're saying is this is always used in the context of married people. What they're saying is any property which is acquired after two people get married, then it becomes their joint property. It becomes community property. Instead of calling it as a joint property, they use this term community property. So if they are getting separated, or if they're having some settlement and all, those properties are all considered to be joint. Doesn't matter who acquired it and all. But not all the states. See, in US is a federal system. It's not a parliamentary system where states will come under central and all, right? And whatever center says, states have to do that. Or center will also allocate budget to them or send them out money. No, nothing like that happens in US. Every state is being run as if they are a separate country. So California has its own laws. Federal government cannot come and tell California, hey, you don't put this law, that law, and all. Like there was nothing saying there. If California wants, they can even like their constitution even allows U.S. Constitution. If California wants, they can tell IRS, not IRS, sorry, U.S. government, we don't want to be part of U.S. anymore. Okay, we are making our own country. And actually, they cannot say anything. Every state is free to do that. They don't do it because this is why like they call it United States, because they all come together and they form a country. So every state, that's why when we are doing the return, we have to see the laws for every state. They're like 50 plus states, and we have to see what is true in California may not be true in New York or New Jersey and all. That's why there are always two returns that we are filing for one taxpayer. One is the federal return, one is the state return. Because federal, it's not like federal will collect the revenues and will allocate them to states, saying that okay, this is how much you get and this is how much you get and all. They don't even care about it. They're like, okay, you guys, you make your own tax laws, do whatever you want to, and you collect your own revenues. So there's something called, so the point that I'm trying to make is this community property law is not going to be common. We cannot even assume that if, let's say, if California has a sales tax of 7%, everybody's gonna have, like all other states will have. Or if California has some other law between like between landlord and tenant, let's say some law that this is how the rental agreement needs to be structured, it could be completely different than what New York says or what Arizona may say and all. So whenever the question arises, if a client comes and says, well, I'm going to have this much income, how much tax we need to pay? I need to pay. We have to ask them, which state are you residing? IRS, we can tell you straightforward what is going to be the tax thing. States, we cannot. We have to go and check what is going to be the tax rate, because states like Washington or Texas and Florida, they have 0% income tax. Even if you make millions over there, you're not paying any income tax in those states, because they're super rich by their own, like, Texas has huge oil reserves and all. Florida has some other thing. They don't even need that their residents to pay taxes. And that's why people want to, or companies are going there now in Texas. They want to set up their businesses there, because even corporate tax is like hardly nothing. It's like very, very low. But California doesn't have any other income, so they are heavily relying on taxes and all. So the community property law is applicable in 9 states. This might have changed because I don't know, like if more states have adopted that law and all. But the question arises, if it's a community property, if the couple is filing their tax returns separately, then which person has to report that rental income? Let's say we're talking about a house or some property which is a joint property, then which person will be taking deduction against it, or which spouse has to put that up as an income, or do they have to do 50-50, Or does it make sense like to do 50-50 when we know that only one person is incurring all the expenses? Maybe one of the spouse says, well, I don't care about this property, like if you want to do it, you just do it. I don't even want rent, I don't even want to take care of any expenses, let's say. Then in that case, who should get the benefit of expenses, and how does the income needs to get split up and all? So those are the areas that they're trying to cover here. If it's not a if it's a no community property state, then it's very clear, like the person who has acquired, that person is the owner, and it's their responsibility to show that as an income and all. And if it's a community property state, it doesn't even matter whose name is there on the title deed. Title deed meaning property papers. Doesn't matter if wife's name is there or husband's name is there, or who has taken mortgage. Maybe only the mortgage has been given only in the name of wife, or maybe only her name is there on the property. But that doesn't matter. It is still considered to be a community property state. So the law says the property which is acquired by spouse after their marriage is considered as own them in the community, because they both are owning it together. But it's only property after marriage. If they have something that they've acquired before they got married, then obviously that depends. I mean, it belongs to that individual person. So joint community income, they call it as a joint property community. If they are filing separate tax return, it could be shared equally. But there are certain, we cannot just go with the rule, but usually they'll be shared equally and all, and the expenses also shared equally. But if they, there are other conditions that only one person is incurring all the expenses, then why should other get the benefit? Right? So that all conditions need to be considered. Wisconsin has implemented a marital property act, and also every state is different. Well, this word has just reminded me of something. I went to some event some time back, and there was the host there was giving this, they have called some chief guest, and they were giving some introduction of this chief guest, and the person said, what did he say? Said something like, this person is an expert in marital arts. Do you know what was that supposed to be? Martial art. He's a black belt in marital art. Yeah, something like that, this person said. Not sure if you got the joke because I cannot hear anyone laughing. But so that was so funny. Oh God, like they were like the whole auditorium was full, some 500,000 people sitting, and just I don't know what this person said, that he's a black belt in marital art. I said, yeah, we should all definitely meet that person who's a black belt in marital art.
I have a question. So there is something called as a prenup agreement in US, right? So if there is a community law in place, which gets preference, the prenup or the
The
community
prenup
law?
agreement will get. That's why all the marriages happening these days, they're going for prenup and all.
Then what's the point of having this?
People usually don't. Prenup is not that common as you would think it to be. It's only like very super rich people, celebrities, and all those who know they'll probably, they're not even sure if their marriage is going to stay or not. They will get it. But prenup is still not that common and all. And again, I don't know much about the legal thing and all, but I know that, I mean, prenup agreement, definitely you can save a lot of your property from getting transferred to another spouse through those prenup agreements. But yeah, not sure how is that applied to IRS thing and all, or what takes preference. But we've heard that a lot of times that because there was a prenup agreement, so this person, like, I mean, they save so much. And there's a prenup agreement with Mark Zuckerberg has done with his wife, even though they were like, I don't know, they've been like in love for so many years and all. But there's a huge prenup agreement, and that was just before Facebook went public, because he knew he's going to get like billions of dollars. So And that's why they were like, I don't know if you search some articles and all, that's why like they say that now, I mean, because of the prenup agreement, it's not like, his wife has also got a big share of Facebook stocks and all those things. So, again, prenup is something like, both of them should agree for it, right? Like,
Yeah, like I think Jeff Bezos didn't have one.
yeah,
So
he didn't have one probably.
correct, because that time he had he started all Amazon post marriage. So
Yes. But even yeah, Facebook was started before marriage and all, but even that doesn't matter. It's just that when he was planning to take it public, that's when he got into prenup. And that was a big news that maybe he didn't trust his spouse or trust his wife, and maybe that's why or people said he's way too smart and all. He knows how to put have a big control on his whatever assets and all. So, and they live in California. So I'm sure prenup agreement or the way there's some laws around it, just don't know much about it. But yeah, you can avoid some of these things through prenups. But Jeff Bezos and all, they're in Washington. So I don't even know if the community property law, yeah, Washington is also covered in community property. Okay. So, okay. So what we need to say is, there are, again, we have to see these laws and all. If some situation like this comes up, that like if they're filing separately, only when they're filing separately we need to be worried about this thing, that what state they're living in, what is the law there, which person is going to report how much income and all. So okay, and then whether it was acquired before marriage or after marriage and all. So, like if it's before marriage, then obviously even California and all the which are community states, they said that okay, if it's before marriage, something was acquired, you file it, and if you're filing separately, you take your asset in your name, and any income which is also coming from that asset, that needs to be reported as taxable income only in the name of the owner. But conversely, something different in Texas, Idaho, Louisiana, and all, that's where they're saying. Even from these separate properties, the income is considered to be community income if the spouses are filing separately and all. So they still need to share it, even though the property was acquired before marriage. So we a lot of times I've seen that we cannot just put in a reasonable assumption that this is the case in California, it has to be the same thing here. We always have to verify that what actually are the laws, what is allowed, what is not allowed. So we'll probably have to go and look into Texas tax law or Idaho tax laws to see what happens if they are filing separately and if the properties were acquired before marriage. Okay, see, some of the states like California and all, they're very, very popular state. All the like probably like a lot of those celebrities, and like because Hollywood is there, all the startup world is there, all these big unicorns and whatever, all these come from California. So California news keeps coming, and so we're kind of still aware of those, but not with other states. So we'll have to go and check. Section 66, it sets forth a specific rule for treatment of community when the spouses live apart. Now, this is again IRC, which is like IRS code. We're just talking about federal here now. The need for this section arose because in community property states, each spouse is liable for one half on the tax. But now they're saying section 66 that generally they'll have to split up the income. But when they're living apart, you also need to see which spouse is keeping that income. It's not fair for the other spouse. If there's $50,000 income coming from one property, it just goes into the bank account of, say, husband or wife, then why does the other person need to pay taxes? It's a burden, right? They don't even get to see that money, and still, just because it's a community property, both of them should split it up. So, IRS has allowed that the spouse that earns the income will keep it, and that person will only pay taxes. And if they're married to each other but live apart and they do not file a joint return, then there are separate rules and all. and one of them have earned income. So, I mean, obviously the rules are earned income, who is earning, that's very clear, right? If the husband is going out and doing the job, that becomes his income, right? All the salary that they're getting. If they're living apart and all. But if they're living together, everything is fine, then again that is considered to be their common income. It's not like only one person is earning and let's say the wife is a homemaker, husband goes out and like, I mean, he's earning and all. It doesn't make that, okay, this income is only husband's income. But if they're filing separately, obviously, then we have to see. Then maybe they have decided to file separately. They have decided not to club their income, not to file a joint return. Then obviously, earned income has to be reported by the person who earns it. Again, trade or business income, if they're running a business and all, then who is running the business? Who has the control of the business? Like, that person will get to keep it. If both of them are running together, again, they'll have to see who gets how much share and all. Community income derived from the separate properties of one spouse is community income derived from the separate property of one spouse is treated as income of such spouse. Yeah, so if it's a separate property, then only that person, even though it's community income and all, that person needs to keep it. Again, there's certain condition that needs to be satisfied for this. All other community property or community income is taxed in accordance with whatever that local law is. So at least they have made this rule that if you are staying separately, it's not like blindly go ahead and just split up the income between both the people. Generally, that will do that. But if one person says that I am not getting any share and all, I don't want to show, then IRS is allowing that. Again, at the time of audit, it needs to be proved that the person who is not ready to pay taxes on it, that has actually not received any income. Okay, we'll just close it here now. Let's just finish up this section. There's something called statutory employees. Employees meaning we all know, right? What form does an employee get? Muskan or Bhavani, what form do you see at the time of filing 1040? Very good, W2. So when you're talking about statutory employees, they also get a W2, but it's called something else. Let me see, what is it called? Yeah, it's just called W2 for statutory employee. There is a little checkbox there. They need to check that. So it becomes a W2 for statutory employee. So what does that mean? That this person is actually not an employee. Somewhere the duties are such that this person cannot even be called as 100% contractor. And it cannot even be called 100% employee. Somewhere in between. Doesn't matter what is the agreement that they're signing among themselves. They can very well sign a contractor agreement. Like those agreements don't matter because it's all internal thing. IRS may still come and say, we are fine, you have signed this agreement. How does it matter to us? Actually, what you're doing is in the capacity of an employee and you call yourself a contractor. Okay. So, and they want people to become employee only. Why? That way there's more payroll tax that they can get it and all those things. It's like, and employers do not want to hire employees because of the payroll tax burden. If they're paying like just the payroll tax itself or medical benefits and all, that may come up to like 15-20% of the total cost, total salary cost. But if you hire as a contractor, all you need to do is like just pay one amount per month and get done with it. No social security, Medicare is given and all. So in the interest of employers, what they say is like, okay, we'll just take you as a contractor. Employee may come and say, well, I don't want to be a contractor. I may want to be an employee. Why? Because the half of the payroll tax is being now borne by employer. So payroll taxes, they come up to 15%. That's a very big amount, 15%. So again, there could be all these things. They can be considered as independent contractors, but what they're saying is there's certain category of people will have to analyze and see what duties they're performing, and maybe they will fall under something called statutory employees. If they're considered to be statutory employees, they need to be issued a W2 with that little box checked, and the social security and Medicare taxes have to be withheld. by the employer, and they need to pay it. So, what category will quickly go over that? Like, I mean, a driver who distributes beverages, like there is a milk, no, other than milk, they're saying. So, driver who distributes like vegetable, fruits, bakery products, who picks and delivers laundry, dry cleaning, and all these services are provided. Maybe the driver is just working as an independent person, but the driver is considered to be the business agent, or is, it doesn't matter how the driver is paid. Maybe driver is paid fixed amount per month, or driver is paid commissions, like how much business he brings in, or driver is paid only on the based on the number of hours, which means that if it doesn't work like 3 or 4 days in between, they don't get paid. Or any full-time life insurance sales agent who's selling these things and all, or any other full-time traveling or city salesperson who is working as a commission basis and all. Okay, so they're all full-time people. If they're doing like this work for more than like one company, 3 or 4 companies, becoming a salesperson or a insurance agent and all, then it's different. Okay, so we'll have to see if we come across this situation, then does it has to be a W-2 for statutory employee, and certain conditions need to be fulfilled. One is that substantially all the services are to be performed by them. Like these people, they're performing all the services, whatever they've been hired for, and they're working like full time and all. Then they do not have a substantial investment in the business. It's not like they are partners there, or they're like, they're becoming a shareholder and all. No, their job is to just do the work and get paid. If they become a shareholder and all, then it's a different thing. Then we cannot call them as statutory employees, because then there is some other kind of interest that they may have in business. And the services are performed on continuing basis. It's not like if they just come and join for like 2 months or 4 months and then going back and like take a break for 4 3 4 months, again come back. That is the case with a lot of seasonal jobs, or maybe when the college students have break 2 or 3 months in a year, they will go and like perform all these kind of jobs and all, like delivery thing, or what we saw is like those bakery products being delivered and all those things. So those are not considered. It has to be a continuing thing, and they don't should not have any other interest besides just providing services and getting paid. And in that case, it's responsibility of the employer to withhold social security, Medicare, and all, and then pay it to IRS in time. Usually, we will not do all of that if they are working as contractors. But some rules of payroll will become applicable here, like FUTA will be applicable and all those things. Okay, but they don't, since they are not like real employees, they are not eligible to participate in retirement plan and all those things. Okay, because they are called statutory employees, just for the purpose of law, just for the purpose of statute, they have been named as employees, but actually they are not. Okay. Okay, with this we'll finish this off, and then we'll start with the next one tomorrow.